Okay, we are on with Preston Pysh. Preston, longtime listener of the podcast, absolute huge fan of yours, man. So I really appreciate you doing this. And for those people who may not know you, can you who are you, Preston? What have you been doing? Can you give a little background, just a bit of context for anyone listening to this?
Yeah, so most of your listeners, I'm assuming, come out of the real estate world. So my background is Warren Buffett style investing. It's going out, finding stable, typically medium to large cap companies, and finding a company that has a good competitive moat that's kicking off free cash flows, and then trying to come up with what I think is the intrinsic value of that business, comparing that competitively to everything else that's out there, return wise, and also from their competitive moat wise, and then buying it. That's the Buffett strategy. So I was implementing this approach to investing for quite a few years, and started figuring out that the money's really broke. Like, my unit of account as to how I'm conducting these calculations is very broke. I started studying Ray Dalio, who's another really famous macro billionaire, the founder of Bridgewater. And he was the one who, I would say, really kind of started opening this idea that there's these long-term cycles. There's these cycles that the money kind of breaks down, and we're approaching what is a 80-year cycle. You could track it back to the 1940s from Bretton Woods. And you can actually see this cycle for people that have never heard of this long-term cycle. You can very clearly see it if you go to a treasury yield chart for the last 80 years. You can see how it peaked in the 1980s, where interest rates were on the 10-year treasury were like around 16%. Interest rates for the last 40 years had come down, and then COVID 2020 happened, and all of a sudden they're not going down anymore. So that is this long-term cycle that's really starting to unwind itself. So, long story short, so Buffett background, started studying heavily into the macroeconomics, understanding how currencies and money itself works through billionaire Ray Dalio. And in short, it led me to Bitcoin. And it led me to trying to find a protection against what I would say is a trend reversal, a 40-year trend reversal, which a lot of people in real estate are very accustomed to, because interest rates kept going down for 40 years straight since the early 1980s until COVID. And through that, you have the compression of cap rates, which means prices just keep going higher. And the interest rates in which you're borrowing money just gets easier and easier. And so people really lean into that trade, especially after 40 years. And they benefited from it, especially if they're using a lot of leverage. They've benefited from it tremendously. And I'm here to basically kind of maybe be a little bit of a canary in the coal mine for this type of person, to help explain to them mathematically why some of this is unwinding itself. Just starting to unwind itself, and then ways that they can maybe protect themselves. And I think Bitcoin's probably one of the primary use cases for protecting themselves against this trend change, this 40-year trend change.
So for anyone listening, Preston puts out a weekly podcast. I always just assume everyone knows about you, Preston, but I'm going to say it anyway. Preston puts out a weekly podcast about this exact topic. And two of my favorite episodes from everything you've spoken about, or one is with Jeff Booth. It's like episode number 157. There's a middle part where he starts talking about the natural state of the market is deflation. Mm-hmm. It's you guys talking about his thesis in his book, The Price of Tomorrow. And he talks about productivity going up 5% a year, and where, we're creating monetary units, and it's transferring control to the state. And I want to get your thoughts on that. That episode specifically really grabbed my attention. But I want to start with a different episode where you were interviewed on what Bitcoin did with Peter McCormick and Nico, who's one of your partners now at egodeath.capital.
Yes.
And you guys, I'm going to put up this screenshot I took of it. You guys talk about, repricing the world in Bitcoin, and you talk about PE ratios. You talk about the history, the compound annual growth rate of Bitcoin, and you have this discussion for probably 10 minutes that blew me away. I'd already been into Bitcoin at this point for about 4 years, but you kind of have layers. I'm sure you've gone through this where you think you understand what Bitcoin means to you, and then you hear something else and you're like, holy shit. So you had this discussion, and I just want to get you to see if we can. I've never done this before. Here we go.
Yeah, there you go.
Yeah, can you see this? Okay.
Okay.
So if you're listening to this, what I have on the screen, you can go to YouTube to view it. But what I have on the screen is a chart of Bitcoin's historical price, which is kind of interesting. But the compound annual growth rate history of Bitcoin, and then also just a random list of PE ratios.
Yeah.
So Preston, I'm just going to let you have at this slide. Can you talk us through some of your thinking when you see this?
So for people, I'll back up for a person that's not familiar with a PE ratio. It's really, really simple. It's the P, it's the price you pay to own an asset, and then the earnings or the profit that company kicks off for the price that you're paying. So let's say I buy a company and let's just say it's a stock. Let's say I pay $100 for that, and let's say it produces $5 of profit in a year, and it's always over 1 year. So 100 divided by 5, and you come up with a PE of 20. And you can see there on the chart on the far right side of what's being displayed there, a PE of 20 is that 5% return. So you could do this for any, price that you pay versus the earnings or the free cash flow or the profits that the company's kicking off. And you get this return profile. And all I'm doing is I'm saying, I'm comparing this to how basically the entire equity market around the world is currently priced. And I'm comparing it to Bitcoin's performance. And this is a lagging indicator. This is Bitcoin's performance over the last, decade. And if you look at the purple portion of the chart there, this is the compound annual growth rate of Bitcoin over any 4-year holding period. So you can go to the Bitcoin price. You're going to see it has tons of volatility in there. And because Bitcoin has this thing called a 4-year halving cycle, I think it's the most responsible way to kind of look at it is to take it in any type of 4-year holding period. And then let's look at the performance in an annualized kind of way over that 4-year holding period. You can pick whatever 4-year holding period you want. I don't care if you pick a top to a previous top or whatever. It doesn't matter. Just pick 4 years. And let's figure out what the compound annual growth rate is. And that purple line is showing you what that is. When you do it, what you find out is the worst performance annualized is around 25%. Okay. The worst performance is 25%. The best performance is around 172% annualized over that 4-year period. And so it's somewhere in there. So if we're just going to generically
just what you said right there is absolutely completely mind-blowing to me.
Crazy. It's crazy.
It's like the worst performance, what did you say, 24, 25%?
Yeah,
Annualized over any 4-year window.
You can pick whatever 4-year period you want out of Bitcoin. Pick the worst, go to the chart, try to find the very worst 4-year period you can find, and it's going to still return 25% annualized.
I think even after understanding Bitcoin as deeply as I thought I understood it, hearing you say that, just this point, never mind what we're going to get to next on PE ratios, absolutely blew my mind because I had never looked at it that way. I had always just looked at what's the historic gain from day one or 2011 or 2013 and how much has it gone up this year or year to date. I had never looked at it on an annualized basis over a 4-year term.
Yeah. And
sorry to interrupt. Keep going.
No. I think it's important for people. If you buy Bitcoin, I tell people that if you're not holding it for 4 years, you're stepping further and further into the speculation category as opposed to an investment category. So if you hold it for 2 years, you hold it for 1 year, I would qualify that as being very speculative. If you're holding it for 4 years plus, I think that it then starts to step into the investment horizon for people. And so I think that that's very important for people to think about, because if you have capital and let's say you can't hold it for 4 years, well, just realize that you're dealing with something that has about 70% annualized volatility. And if you get that timing wrong, or you just can't hold it for 4, that you might be exposed to a lot of downside risk just because of how volatile it is. People would say, well, Preston, why in the world would I want to own something that volatile? And what I would say is you have money that's trying to become the new global settlement layer, which is hundreds of trillions in market cap and size. And today it's a little over $1 trillion. And so you have this seed that's trying to sprout into a redwood tree. And that process is volatile as it's trying to discover what the real value is. And so that's where all the volatility is coming from. But that volatility is also a massive amount of opportunity for anybody that would dollar cost average or slowly step into something that has that 4-year horizon plus for their holding period. Now, I would not be a good steward of the listener if I don't say that this is past performance. This doesn't guarantee future results, right? But I'll counter that with, when I look at the adoption, the growth rate, the number of participants, the ETFs, the number of people that are stepping into this, and the network effect that's being achieved in an open source protocol, it demonstrates a growth rate that's on par with what we've saw with the internet. It is not like a stock with respect to the growth and the metrics that you'd use to really kind of assess value here. So going back to the PEs. So if we're going to look at this and we're going to say, hey, like the worst performance is 25% annualized, that means you're looking at a PE of a 4, right? In terms of stock, like if you're going to compare it to a stock, and anybody that's in equities knows that if you're buying a stock with a PE of 4, typically there's something that just changed, that the market is penalizing the price severely, and the competitive moat or the company's ability to kick off the free cash flows is about to be impaired if you're getting those types of PE ratios, because the PE of 4 is unheard of. For people that aren't intimately familiar with public markets, today I would tell you public markets are around a 25 to a 35 on the PE scale, which is priced at like 3 to 5% for any type of mid to large cap company that's profitable and has a competitive moat. So when we're looking at this and we're saying, good Lord, like this CAGR for Bitcoin has been as high as 172%. That's a PE of 0.58, which is completely unheard of. It's like these numbers don't even make sense to anybody who typically participates in traditional markets. So we're in that lower, on the right side of this chart that you're looking at, we're in that lower quadrant of Bitcoin's worst performance to best performance. And then I would argue publicly traded equities and fixed income are up in that upper quadrant. Like overnight money and 3-month notes are yielding around 5%, which would be a PE of 20. That's really kind of the comparison, which is really. So
Preston, just on because this to me is such a huge deal. So if I'm to break it down, and please correct me if I'm explaining this incorrectly here. If I'm a company that's valued at, let's say, $100 million, and I'm kicking off $10 million in cash flows a year, that would be a PE of 10.
Yes, correct.
Correct? Okay.
Yes.
So, and the general stock market isn't at a PE of 10. You're saying generally most stocks on average right now are at like, 25, 30, 35 range, a PE of 25, 30, 35 range, which means they're kicking off a return of not 10%. They're kicking off a return of, or growing, I don't know the right language or the best language to use for people to explain this point, of somewhere between 5%, 4%, 3%.
Yeah.
Correct.
What's really fascinating is if you would take, let's say a person is hearing this and they're saying, okay, this is really interesting, but I'm not willing to jump in the water. I just want to dip my toe in the water. For that person, I would say, hey, you want to own the S&P 500. You want to own QQQ, the NASDAQ or whatever, right? Do it, but maybe dabble like 2% of whatever let's say you were going to put $100,000 in the S&P 500. Maybe you put 98,000 into the S&P 500 and you go and take 2,000 and you put it into Bitcoin. And what I think you're going to find is when you go and run those numbers and you look at what the performance would have been over the last 4 years or 8 years, and I would encourage a person to pick 4-year holding periods. When they do that, what they're going to find is the performance isn't a little bit better. In some cases, it's twice as good. Like if you got 20% in the S&P 500 with just a 2% Bitcoin allocation, you might be as high as like 40%, which is insane. So you go run the numbers, you go do the math. And I think when you do, you're gonna find that, and think about it. The thing that they always say in finance, this is the thing that blows my mind, Tom, that you manage risk by position size. Okay. So you might look at this and say, oh, 70% volatility. I don't really even understand it. And all these arguments, right? Maybe they might be wrong. Okay. Well, then manage your risk with position size. Because when you're getting these types of returns, you don't need a lot on it in order for it to provide a lot of performance. Bitcoin has had the best over any 4-year holding period, has had the best Sharpe ratio out of anything on Wall Street.
What's a Sharpe ratio? Can you explain that?
The Sharpe ratio is looking at the performance and it's looking at the volatility. Okay. And it's a ratio. And so although Bitcoin has 70% annualized volatility, which is like absurd amount of volatility, because the performance is so insanely high compared to that volatility, it's still like way better, like 3 times better than like the S&P 500 or the NASDAQ. I don't know the exact number, but it's around that ballpark, like 2 to 3 times better on a Sharpe ratio. And so how do you manage that? You manage it through position size. You should take if that's too much volatility for your portfolio, let's say you're older, you should have a smaller position size. It's that simple.
Once you understand this and you look at those numbers on the right-hand side, I think what struck me was like, holy shit.
Yeah.
The equities need to be revalued because me holding my Bitcoin right now, if you look at a 25% return, that would be the equivalent of a PE of 4 on this chart. Why would I give up any Bitcoin in exchange for an equity when the PE of those equities is 20, 25, 30?
I know.
Like it doesn't make sense for me to trade something that is, operating at a PE of 4 on the low end. That's what we said was the bottom 4-year compound annual growth rate. Why would I trade that up? And then I start having because that's where my brain breaks. It's like, holy shit, what is going to happen to the future of equities?
Yeah, well, they're going to get repriced. And for people in real estate, so cap rates, so that's what people understand in real estate is cap rates. So I'm not intimately familiar with your, where you guys are doing those investments, but let's say the cap rates are 7 or 8%. If you pull the PE back up again, is that close to the cap rates that you're seeing right now, Tom? What are your cap rates?
Lower.
Okay.
Yeah.
So let's just say they're 5%. So that's a PE of 20. You can see it right there on the chart. The cap rate of 5% is a PE of 20. And if let's say you're in a market where they're not nearly as compressed and they're 10%, you can see the return is 10%. And just compare that to Bitcoin's worst performance over the last, decade over any 4-year holding period. And it was 25%. So, you're getting 5x the performance without the operational excellence that's required, right? Without having to make underlying CapEx assumptions, which I hate to tell people in real estate, but CapEx in the coming 10 years, hang on to your hat, because I think it's going way higher, and that expense structure, which is playing an enormous role into your ability to extract free cash flows out of the business in a sustainable way, I think is going way higher.
And you think that's going higher because of just inflation?
Because of inflation. So when we look, what's driving inflation? The fact that you have the federal government's interest expense matching the defense budget, which is already 10x that of any other country in the world. I'm sorry to break it to you, but the way that they deal with that interest expense that's running away is they print more money, which then further compounds the interest expense because the fixed income market starts pricing that in by selling off debt, and there's no buyers for anything that yields lower than what the inflation rate is. You can see all of this in the M2 money growth rate versus the size of the debts. And it's to me, it's very obvious that we're going to be dealing with 5% plus inflation And if you're a real estate developer that purchased property in 2020 when inflation was 0.5%, which I would argue was the tippity top of a 40-year bull market in real estate, okay? And now that trend is reversing itself. If you were making underlying CapEx assumptions on the value of that property back in 2020 at 0.5% inflation, and now it's going to be 5%, maybe even more for the coming decade, I hate to tell you, that adds up to enormous expenses because it's compounded, okay, year over year. Not to mention OpEx. So if you hired a plumber 4 years ago and you hired a plumber today, what do you think the price difference is for that plumber just over the last 4 years? It's twice as much, at least. Okay. And if you think that that's going to slow down in the coming 10 years with the amount of sheer debasement that they have to do to offset these debt loads and like where it's going next, I'm sorry, I don't have good news for you.
And you've said so much there. And a country like Canada, you have to be aware of that, because if the reason we study the US so much up here and we share it with all our clients is that if the US is going to go down that path, Canada has to do it more. We can't do it less than the US. Like if the US is going to debase, we depend on a weaker dollar for us to be competitive in a global market. Yeah. So we have to debase further. So like our fiat dollar has to be worse than the US dollar. So everything you're saying, I agree 100% with, and it has to be, I think it's just worse in Canada.
It's magnified.
It's just magnified. And when you had Leon Vancombe on your podcast, that was interesting to me, because exactly what you're saying with an equity portfolio, or, whatever somebody would consider a diversified portfolio these days, if you add a little bit of Bitcoin, what it does to your portfolio, the same thing applies to real estate. If someone's not going to go all in and thinks that's too dangerous or too risky, if you do what Preston's thinking here and you just add a little bit of Bitcoin, whatever that is to you, 2%, 5%, 10%, 15, whatever, to your real estate portfolio and go back in time and look at the returns, the same thing happens. Yes. Bitcoin enhances the returns. And I can tell you that having Bitcoin on a balance sheet for a business, if you're a real estate investor, it really protects you because the value of your Bitcoin is going up. So just kind of like, I guess in a tiny way, like Michael Saylor is doing with Microstrategy. Everybody can do that themselves, which is beautiful. So if you're still committed to whatever business or real estate portfolio you are building, adding Bitcoin to your balance sheet smooths out the edges, because Bitcoin over time has that growth rate that really gives you some purchasing power that protects your business. We've seen it ourselves. Nick and I have seen it ourselves.
If I'm a real estate developer or investor in the coming decade, this is how I'm thinking through that, right? If you said, Preston, you have to be a real estate investor and developer, I'd say, okay, this is how I'm doing it. First of all, I have to live in an area, or I have to invest in an area that has population growth. Okay. Next, I'm trying to find land or desirable property where that population growth is the strongest and most desirable. These are obvious things for anybody in real estate. Next, I need to make sure that the property obviously is going to be able to have the utility and isn't going to become impaired because of work at home and like all these other policies that have had a kind of a monumental shift since COVID. Next, from a operational balance sheet financial engineering standpoint, I want to lever the properties as much as I can, okay, in a responsible way. And then whatever's left over of what I would normally have maybe put into the property, I'm putting that into Bitcoin as an insurance hedge against my CapEx and OpEx expenses for that property. This becomes a min-max equation, right? Let me give the audience a really basic example of what I mean by this is a min-max equation. Where I live, the property values just for homes alone have nearly doubled since COVID. And I know that that's not a normal stat, but here it is. They nearly doubled. If you were going to buy a house back in 2020 at the interest rates, which were screaming low, 3.5% or somewhere in that range, right? The best way, let's say you had a $400,000 house. the best way to do this was to go out and let's say you could get a 10% down, 20% down. I'll just use 10% because the numbers are really easy. I go out, I borrow the whole $360,000. I put 10% down, which is only $40,000 of my principal. But let's just say I had $400,000. Okay, let's say I had that full amount and I could have bought the house outright. Dave Ramsey would have told me to buy the house with all the money, right? But the person who understands like what's playing out here, they would have put the 10% down. They would have bought the house. That $400,000 basically returned $400,000 because the house is now worth $800,000 after 4 years here in this local area. So that $40,000 investment turned into $800,000. The price of Bitcoin back in 2020 was under 10,000. We'll just say it was 10,000. Okay. Today it's at 57,000. So with the 360,000 that I didn't invest into the house, I went and bought what is that? 36 Bitcoin. Mm-hmm. Okay. 36 Bitcoin today. Let me do the public math here. I'm going to pull out my calculator real fast. Right. So we have 36 Bitcoin times $57,000. And that's worth $2 million. Okay. So with $400,000 back in 2020, I made $400,000 on the home with the 10% that I put down. And then I made $2 million with the $360,000 that I invested into Bitcoin with the remainder for a $2.4 million, principal on $400,000. That's the min max. Okay. So here's a person after 4 years that could have taken $400,000 and turned it into $2.4 million. You can figure out whatever the IRR is on that, but it wasn't all in Bitcoin. It was a small percentage in real estate. It was a lot more in Bitcoin. And the hybrid and the mixing of this, because what I'm doing is I'm leaning into the legacy fiat fractional reserve debacle. I'm levering the hell out of it, and I'm using it. And I know this is an extreme example, and like you got to do things responsibly, but I think you can really understand something.
Yeah, it's helping paint a picture. Yes.
Yeah, you can understand something when you stress it to the max or the threshold to kind of understand the sight picture of what I'm describing. And what I'm really getting at is you need a hybrid approach in real estate to literally maximize the min-max equation of being in both of these things. So am I saying that's what people should, the example I'm just using it as an example to illustrate how a person in real estate can hopefully maneuver themselves well in the coming 10 years.
With what you're seeing on the markets, and I don't know who you're speaking to through egodeath and companies or some of your friends who are kind of in regular finance, what do you think happens to to just the equity markets? They get revalued against Bitcoin. So like in nominal terms, do you think we just see the stock market do what it does? Nominally it goes higher, debase more money, print more money, nominally goes higher. But in Bitcoin terms, over the next 5 and 10 years, this trend continues and it's just completely repriced in Bitcoin. And if that's the case, companies in the S&P 500 who have Bitcoin on their balance sheet, do they just become uber powerful? Like what goes through your mind when I say this stuff?
The entire equity market is going to be repriced in Bitcoin terms. And today the equity markets are grossly, absolutely disgustingly priced in my humble opinion. Mm-hmm. And what I mean by that is like, think of how absurd this is. You're going to go out and you're going to buy a company and it's going to give you a 3% return. It'd be like me going and buying a coffee shop for $100,000 and it only gives me $3,000 a year. After all the work and all this stuff that people are doing, it only makes $3,000 off of $100,000. That's how the entire equity market is priced today. Think about
This is what's blowing my mind, by the way. This is what is blowing my mind. Go on.
Yeah.
Sorry.
Yeah, but think about the risk associated with making that $3,000 on the $100,000 down. And think about the time to return the capital. You're 33 years just to get your principal back from a profit standpoint by paying these prices, right? It's absurd. So for 33 years, I've got to sit there and hopefully the employee doesn't light the place on fire. Yeah. Hopefully the
board doesn't do some stupid decision. Yeah, exactly.
Right.
Yeah.
This is how the entire planet has priced all the equity in the world is you've got to sit on these things for 30 odd years. And hopefully the operators don't F it up just for you to get your principal back. It's insano world. It's clown world, right? For anybody that's just looking at it objectively, like stepping out of the day's confusion they are, oh, well, that's just the price everybody pays, 35 times earnings. It's just normal. No, it's not normal. Okay. I want to grab you. I want to shake you. And I want to say, wake the F up. Okay.
I think what's difficult for people is once you understand some of this, and Bitcoin's really so simple. Yeah. Because it has a history now, and you're like, wait a second, all I really have to do is buy this thing and just hold it. And that's all I have to do, because I'm so used to valuations, or in real estate, you're using strategies and refinancing and banks. So like it becomes so simple that you don't think it can be true. In my case anyway.
This is a cognitive bias. Everybody knows that the only way you can have outsized returns is through hard work. Okay. But let me tell you, Bitcoin is hard work. It's intellectually difficult to wrap your head around all the different things that you've got to understand in order to just buy it and hold it. Because most people buy it and then the price goes up and they're like, oh my God, I'm going to sell it and I'm going to make a bunch of money. And then it goes down. And like, the person who deeply, deeply understands it can actually buy it and hold it, and they never have an incentive or desire to sell it because they put in an enormous amount of intellectual rigor to actually understand what they own. So back to your original question, which is the repricing of equity around the world. Michael Saylor, this is a PhD case study on a person who actually understands the legacy price premiums and risks associated with these insane cap rates and is levering the living hell out of it. And here's let me explain this. So Michael's going out and he's just issuing more common stock. He's raising cash. He's taking the cash. He's buying Bitcoin with it and then sticking it on his balance sheet. He's a profitable business. He's also doing things in the fixed income market, the convertible debt markets, which I could talk about. But I want to talk about him transmuting common stock into Bitcoin. Okay. Anybody that understands public markets knows that when you issue more common stock, you're diluting the value of the common stock when you do this. The stock price should go down, correct? When you do this, guess what's happening with Microstrategy? It's accretive. He is issuing more common stock, transmuting it into Bitcoin, sticking it on his balance sheet, and the price of the common stock, even though there's more shares outstanding, is going up. Okay. And it's going up by a lot. And the reason why he's doing this is because he's doing exactly what we just talked about. He's looking at the broader equity markets and he's saying, this is clown world that everything's priced at 35 times earnings. Okay. In the future, in this Bitcoin world, I think things are going to be priced at, call it 10 times earnings. Okay. And if that's true, that everything's going to be recapped, and instead of it being in real estate terms, instead of your cap rate being 3%, it's going to be 10%. And you believe that the trend is moving from 3% to 10%. What do? You sell that equity as much as you can, and you transmute it into the thing that's going to give you the better return, which is in Michael's mind is Bitcoin. So yeah, I mean, it's if you really want to dig in, you really want to understand some of these ideas. Here's a billionaire that's literally out there doing it aggressively. And doing it in a very demonstrative way.
I feel like he's laughing the whole time he's doing it.
He's laughing. Yeah. I promise you, he's probably laughing his tail off. Like, I can't believe nobody else can figure this out.
But the strategy applies to, like, especially if you have unleveraged real estate right now, if you're fortunate enough to have a couple rental properties unleveraged and you're just convinced I'm absolutely not going to sell them. Yeah. Then you could do the same strategy. An unleveraged piece of real estate is really just growing with debasement at like 7%. Yeah. So you can take some credit on that property, take the money, buy Bitcoin, do exactly a mini Michael Saylor as you, the real estate investor. If you wanted to hold those properties, you can do the same thing. And an unleveraged piece of real estate, look, the only thing that gets real estate exciting at all is the leverage. Like that is the only exciting part about it. Otherwise, it goes up about 7%. It's keeping up with just debasement. You're going nowhere.
Bingo.
So the leverage is what gets exciting. Put 20% down. Historically, it goes up 7%. That's like a 35% return on the leverage. That's where it got interesting for us. But now when you layer this in, things kind of really change. I want to just change gears a little bit here. On that episode where you talked to Jeff Booth, it's your episode, BTC 157 of the Investors Podcast. You talked to Jeff Booth, and I had to listen to this a whole bunch of times as well. I had already read his book. I had probably listened to like 20 hours of Booth and you. But then he starts speaking. You know when Jeff sometimes speaks and you're like, what the hell what did he just, what did he just say? And I had to rewind. It's like the middle third of that episode where you guys talk about AI and productivity. And I just want to set the tone here. Debasement in the US and Canada, roughly the same 7% a year. Debt in the US, I just checked just for fun. Like it's now 35 trillion, 282 billion. Like I feel like it just crossed 35 trillion and now it's just an extra 282 billion. I don't know. And like, I feel like 10 days or whatever it is. I guess maybe it's a little bit longer.
It's like $1 trillion per quarter, I want to say, honestly.
When we started tracking the US for our clients in 2008, the total US debt was 8 trillion. 8.
Yeah.
8 trillion.
Yeah.
It's now 35 trillion.
It's not linear. People need to realize none of this is linear.
Okay. So this is where I want to go with now when you mix in AI and what Jeff was talking about. And you know how he talks about the real productivity gains is probably costing us about 5%. Things should be going down about 5%. So if inflation is like, if we're going to accept whatever number we want to accept, let's choose 7%. And then, if productivity gains are costing us 5%, really it's like we're losing 12%. And he starts framing it in this way. If AI starts to get regulated by the government, and that centralizes control over AI into fewer and fewer corporations. To me, what happens in the US is the GDP struggles to grow because as AI introduces productivity enhancements, we're going to have labor changes that's going to result in less human labor until maybe something changes a few years down the road, at least initially less human labor. In that environment, and then you're going to have the centralization of AI amongst a few bigger and bigger companies. Those two things together, less labor, centralization into bigger companies, to me means the US GDP is going to struggle to grow. Let me just throw this one last thing out here. If the US GDP struggles to grow, but the debt, so if the GDP is here and the debt is still a huge amount, the amount of inflation coming our way with just the mathematical trends that have got us to this point. But if you now put in AI to this, the amount of inflation coming our way isn't going to be linear at all. It is about to go to some
crazy number.
No,
you're not missing anything. The ratio that you're talking about, which is the debt to the GDP, is what to pay attention to. Because if you're looking at just the GDP in nominal terms, you're going to watch it continue to blow out. Because as they print more and more money to offset all this, the GDP is just going to consolidate into the same 5 companies, and you're going to watch their numbers skyrocket. And like the numbers
exactly
in nominal terms is just going to keep going up, which for most people, when they're looking at this and like, well, GDP's up, and they end of argument, end of analysis, end of critical thinking, right? So, and I don't even like the GDP number because you're using a Alice in Wonderland type ruler in order that's just constantly morphing and changing, and you're not able to actually see what's happening. This is where I would challenge people to think very first principled and very deeply on this call right now, right? You and I are having a conversation over Zoom. Okay. Let's warp ourselves back 20 years ago. Or 30 years ago, how would this face-to-face video discussion have taken place? Well, I would have had to book a flight. We would have had to, find a common meeting ground and just add up all these bills. Okay. The flight, the rental of the facility, the cameras, the post editing, all of it, right? How much would that have cost? Technology has enabled us to literally click a button. We're going to record this. you're going to release it.
Mhm.
You're going to have however many, tens of thousands of people or whatever watch this. Imagine if you were going to do that live and like you had to get an auditorium full of people and they all had like all of these things are costs. Technology is insanely disruptive. And what it does is it removes cost, right? At its core, technology makes things cheaper and more affordable and efficient. Okay. So why in the world are prices going up for certain things? You put gas in your car. You don't think we've gotten more efficient at making gas over the last 40 years and the prices are higher? That don't make any sense, right? Just like take a step back. Again, shake yourself out of this like confusion. It's like, how in the world have I been convinced that gas prices should be higher? Right? They shouldn't be higher. It's because they're changing the units, the monetary units, the supply of those monetary units, and they're duping everybody into thinking this is a good thing.
Yeah, GDP up means good. The economy is growing. It's good.
It's not a good thing.
Yeah, agreed. Yeah, and so over the next few years, I just feel like it's going to catch a lot of people off guard on what's going to happen to the. We talk a lot here about that. Canada has had a great middle class, but there's a growing wealth divide happening here, those with assets and those without. And I just feel if you extrapolate these trends going forward, it's going to get worse. But Bitcoin introduces this new thing that you can kind of latch onto, that you can really save your purchasing power. It's almost like exiting one financial system. It's like there's this whole other system being built around this thing called Bitcoin, and people aren't catching on. And it's the hardest thing to explain to people. I just constantly, I just can't.
Tom, here's an interesting stat for you. So I tell you to think in 4-year holding periods, right? So let's go back 8 years, and let's say you have a $350,000 house, okay, in dollar terms. This was almost 1,000 Bitcoin 8 years ago, okay? 1,000 Bitcoin.
Yeah.
So then let's warp to just 4 years ago, okay? Same house. It's now, instead of it being 350,000, it's around like 390,000. So the typical person living in legacy land is saying, wow, my house it went up in value. It used to be 350. Now it's like 390. Okay. The Bitcoiner is looking at this and they're saying, well, the house used to be 1,000 and now it's 40. It used to be 1,000 Bitcoin. Now it's 40 Bitcoin. Now let's warp to today. Okay. That same $350,000 house, around $500,000. Okay. So again, the person living in legacy world is saying, my house just keeps going up in value. I'm appreciating. It's getting easier for me. I need to take out another loan against the house because now it's more valuable, right? The Bitcoiner is looking at it, and guess how much Bitcoin now? 12 Bitcoin. You went from 1,000 Bitcoin price to 10, 12 Bitcoin, right? So for me, because I've been living in this Bitcoin world for this period of time.
Yeah, life's getting cheaper.
I'm looking around, I'm saying, my God, everything just keeps getting cheaper. Like not just a little cheaper, but like aggressively, absurdly cheaper. And I can just do more things because everything just keeps getting cheaper.
I think that's hard for people to grasp because you've been able to move enough of your savings, enough of your purchasing power into Bitcoin that you can clearly see it. I think when people begin with like $100, $1,000 or $10,000, they're still looking at it in fiat returns and they can't see it. I remember having a moment myself where I kind of looked around. I'm like, holy shit, the world's getting cheaper around me just holding this thing. Yeah. Like it is a bit of a reframing, a moment that you have to go through yourself. And when you're first starting with your first allotment to Bitcoin, it is difficult to comprehend, Preston, what you just said. But once you understand that, it's game over.
One of the biggest like aha moments for me in Bitcoin, I was, I talked at the beginning about being a Warren Buffett investor. So one of the things that you do when you're trying to do this Buffett approach is I would always take like the last 10 years of a company's performance, the revenue, the net income, the profit, and I would plot it. And so like I was looking at Apple, and I'm looking at the top line of revenue of Apple, and I'm looking at the bottom line, and it's just trending like straight up and to the right, a little bit of like a bend in it. Like they're just killing it in dollar terms. I go back, this is, 10 years of this. I go back and I redenominate each one of those years into Bitcoin. And the reason I'm doing this is because I'm saying, okay, so the projected free cash flows for the next 10 years look like this. This is the current market price.
Yeah, you were being smart. You were being smart.
I'm just figuring out the IRR, the internal rate of return. I'm saying this is the projected free cash flows. Here's the current price that the market's offering me. And if I have those two variables, I can solve for the third one, which is return. And I was coming up with, at that moment, I can't remember, maybe a 10% return, which was really good. Okay. But then I went and I was like, you know what? Let me do this in Bitcoin. Let me go back to each one of these discrete years and redenominate the top line and the bottom line in Bitcoin. And what was so mind blowing to me was the chart. The line wasn't going up and to the right. It was going down and to the right. And I'm saying, hold on a second. Like, how do I even value this? How do I even come up with an IRR if I think that my free cash flows are a diminishing return of free cash flows going into the future? And this is Apple, mind you. This isn't like some small cap company. This is the company that in that moment was murdering it better than anybody else on the planet. And I'm saying, oh my God, like I got to rethink everything because this is just.
Who would have thought Apple's purchasing powers in Bitcoin terms is decreasing? Like, I don't even know if they realize that yet. So then what do you think happens? Like, I don't know if this is stuff you guys are talking about internally at Ego Death. And I should mention that I'm part of Ego Death's fund too. So just so everybody knows when I talk about Ego Death, but Ego Death, when you guys are looking at companies, have you started analyzing, and I don't know how much you can share and not share, but are you starting to look at companies who are earning in Bitcoin? Because when you start, I guess that's just the natural thing, because anyone who's not earning in Bitcoin, if you're earning in fiat, Canadian, US dollars, whatever it is, you better as a company be making profit that you can then stash in Bitcoin. Because if you are not, there's just no purpose for your existence anymore.
Well, really. Let's go to let me talk to Apple, and then I'll talk more specifically on like VC, venture capital, because it's a different animal. So on the Apple piece, if you're going to look at a company that's still got a competitive moat, like the market's still going to desire their goods and service, they're still going to make money. They just continue to make less and less money because you're dealing with Bitcoin. Okay. How do you value it? Well, you need a severe discount in the price in order to own it. It's just that simple. So let's say I could get it for a PE of 5. Well, at a PE of 5, I'm getting a 20% return. And we already said that Bitcoin's the worst compound annual growth rate was 25%. So even at a PE of 5, I'm still not interested in owning this thing because because it's just so
the return that you're getting isn't matching just holding Bitcoin.
Yeah, like I would need a PE of around 3 or 2 or 1 for it to even start to enter my frame of consideration. Which but let me tell you.
No, but it does help all of us because it means only companies producing a lot of value to the community, the society, the country, the nation, whatever exists. Yes. No.
Exactly. So now as you look at, well, why am I doing egodeath.capital? When you hear me say all these things, you'd think the guy would just be buying Bitcoin. Well, the only thing that I have found that I think can outperform these numbers is early stage venture capital companies that are literally building infrastructure in Bitcoin and in this new world of finance. Because like if you can go in there and you can buy a company for, call it $10, $25 million, and you think it has the potential to become $1 billion, and I'm using fiat numbers here because your audience are going to understand those numbers better, right? If I think that business could become $1 billion plus business, well, now you're looking at a growth rate that can actually outpace Bitcoin's, call it 25 to 50% hurdle rate. And once they become free cash flow positive, which a lot of these companies, if they are winners, it happens way earlier than other startups, traditional fiat startups. And so you got this kicker of not only the growth rate that can outpace Bitcoin, but you also have a founder and a CEO that's thinking about treasury management and operational return profiles that when they make money, when these companies make money, they're looking at it and saying, all right, can I invest operationally back in this business at a hurdle rate above 50%? Because if I can't, I'm just going to hold the Bitcoin. And if I think I can, a lot of early stage, if you're dealing with a company that's under 100 million in market cap, sometimes they can go find operational opportunities to return it at 100% plus because of where they're at. So that's why we're in that space, and because it's the only space that I have possibly found that can outperform Bitcoin's performance. And obviously because I'm interested in furthering along the Bitcoin from a payment standpoint. You go into some of the parts of the world where they don't have access to banking and all these things. I think there's massive opportunities for this. And so
Sitting in your seat, you're seeing some companies start to think this way and produce income.
Totally.
They're earning cash flow in Bitcoin.
No doubt. In fact, I would tell you, I haven't met a founder that's investable that isn't thinking like that.
So they're not just making companies that are serving the Bitcoin network community, whatever. They're earning in Bitcoin.
Yes. Yeah. And even if you're accepting fiat, the way they're thinking about it is anything that's free cash flow generative is swept into Bitcoin.
Immediately
swept into Bitcoin.
Yeah, I think that happens to every corporation. It's happening to our business. All our free cash flows go into the corporate treasury as Bitcoin. Like, it's immediate. Yeah. We don't need the operating capital, immediately into Bitcoin. That's right. I mean, Ali at Tahini's, he's just down. Yeah, he's you can see it starting to happen, but you're seeing it at a different level, because I never really thought about earning the cash flow or the income in Bitcoin denominated terms. Like, you're earning Bitcoin directly. That kind of changes the whole thing.
Yeah.
Okay. So,
and if you're earning in Bitcoin, and let's say the business, just to kind of pull on the thread a little bit more, if I'm a founder and I have fiat denominated expenses, let's say I'm earning 100,000 worth of Bitcoin. There's 50,000 of expenses. I should be, at the end of the month, it's net 30 or whatever. I should immediately be converting that 50,000 into USD, so that I can make those payments in a responsible way and in a reduced risk kind of way. As soon as it comes in the door, it should be this automatic swap of, these are my expenses. This is now once the expenses start getting denominated in Bitcoin, watch out. The game's going to change even more drastically, right? But this is how founders should think. Any excess production that exceeds my expense structure should be swept into something that is a safe, reliable store of value. If you're profitable, you can hold it for 4 years, because next quarter you're profitable again, right? This is why Saylor is able to do what he does, because he makes $100 million a year. He's profitable. If you're not profitable, then the game's very different for you. You're struggling to stay alive. And Bitcoin doesn't work for dead zombies that don't make money.
Yeah. What's wild about what you said? When Amazon started, and so many people dismissed it as like, oh, they sell books online, useless. Like the early 2000s, Amazon was like, kind of laughed at. And then Amazon went on to do what it's done. But that was, and it definitely affected, let's say, all of retail. Like, let's kind of, Amazon has reflected. We have a place in Croatia on the Adriatic coast. We get Amazon deliveries to areas in Croatia that I never thought you'd get Amazon deliveries. All right. So you get Amazon deliveries there. That's retail. Now let's think about what you just said. What you just said is applying to the entire unit of account for the entire world. And this is what sometimes people can think, Tom, you're just going crazy on this Bitcoin thing. But this is what starts blowing my mind, because I'm like, holy shit, if Amazon did that to retail, what is Bitcoin about to do to the entire economy?
Yes. Yeah. Hang on. On the Amazon thing, there's an interesting tidbit that I had a conversation with Bill Miller, I don't know, many years ago. And I said, Bill, how did you get Amazon so right and everybody got it wrong? And his answer was really simple. He says, well, a lot of people thought that that R&D wasn't expensed on the income statement, and they didn't think that they made any money. But the fact that the way the accounting treatment, so Amazon's making a ton of money. They're taking what would have been free cash flow that would have been stuck on the balance sheet, either through marketable securities or whatever, and people would be looking at that and saying, "Oh yeah, they're making lots of money. Let me value that." Right. But what Amazon was doing is they were investing operationally back into their business, It's all being marked as research and development, which is an income statement expense that quarter. And it makes it look like they're not making any money. And then it gets listed as just a, you would just mark this new asset on your balance sheet with no value because you expensed it over on the income statement. And so a lot of it was masked because Jeff Bezos was so hell-bent on continuing to expand operations through organic investment, which was being marked down every quarter as R&D. Yeah.
Okay, I only have you for a little bit more here. I want to do some rapid fire with you. You ready? So I got like 3 or 4 rapid fire questions. What's next for nation state Bitcoin adoption?
I think that it's similar to on the corporate side where Michael Saylor is putting on this clinic of like what happens if you really lean into Bitcoin at the corporate level. You have a very similar thing playing out with El Salvador right now. I think it's going to be a little bit more challenging for other nation states to do it so demonstratively like Bukele has done, just because you're dealing with a lot more voting members and people that you just can't go do what he's done. But I think that in another 4 years, it's going to be so obvious as to the changes that are happening there, especially from an investment standpoint. If you're a Bitcoin business and you're not like contemplating, domicile, putting your business inside of El Salvador, like I don't know what to tell you, because there's just so many benefits to them to be able to do something like that. Look at their bonds, best performing bonds on planet Earth for sovereigns. Look at Microstrategy's bonds, best performing bonds on planet Earth for corporates, because there's Bitcoin involved. And these are convertible, like they're tripping over themselves to own these things.
And the capital and human capital that places like that are about to attract, because look at Canada right now. We didn't talk about it, but when you said things are getting more expensive, we have a carbon tax here. I don't know if you know that. Like when we go to the pump and fill up for gas, we pay the already high gas price, and then we pay a carbon tax. So then you look around as a capital allocator or a productive member of society, you look around saying, well, why would I further grow a company here? Like this is just the thought that goes through my brain. Like why would I, as the product, as things are taxed here more, the productive people leave faster, causing the whole.
This is what's so fascinating, and this is a whole nother topic, right? The whole carbon tax. They need demand to slow down to help mask CPI, which is a giant scheme in and of itself. And if a person wants to do a little research, I think they're going to have a treasure trove, endless hole to dig on that comment. So I'll leave it right there and let the listener do a little research.
Next one, price predictions for Bitcoin. I know you love. No one's holding you to this, Preston.
Yeah,
you have at it. 1 year, 5 year, 10 year. I don't know what comes to mind.
We're going hundreds of thousands of dollars in the coming year and a half. I think hundreds of thousands. Wow. I think over 200,000 easy.
So M2, the M2 money supply just starts to ramp up big.
Yeah, and there might be a lot of volatility between now and call it Christmas of 2025. But I think between now and then, it's going to really start to rip. But I do think that we are in we have a credit cycle that's been trying to play out since COVID, that the amount of printing that they turned on during COVID masked it. You're seeing it now showing up in the unemployment numbers, and this thing's really trying to unwind itself. So the ability for it to unwind is completely dependent on the speed and magnitude of the central bankers and how fast and quickly they step into this thing. They could come out tomorrow. I mean, think about how we had nobody working during COVID, and we had one of the most face-ripping equity markets on planet Earth. So anybody who thinks that, because I hear this all the time, oh my God, this is going to be like a 1929 crash. And I'm just like smirking. I'm just like, did you not remember what happened in COVID? Like, they can come here, they can print tons of units, they can stuff these things into the economy, and you're going to watch these markets rip. They could do it tomorrow. They could wait. They could take their hands off the controls, and they could let this thing unwind and really melt down. Okay. And then they would have to step in with even more printing that would have been required if they just kind of started doing it right now. But my point is this, completely has to do with the 10 people sitting in a room clacking on keys as to how many monetary units they're going to add or not add or slowly add or whatever. And I can't predict that, but I do know this: over a 4-year holding period and period of time, they are going to expand the monetary units aggressively. And that's going to show up in the price of Bitcoin at some point.
I can't remember if it was 2020 or 2021. I can't remember which year it was off the top of my head. The real estate market here, because Canada is just so heavy real estate. December, everyone goes away for the holidays. January, somebody in our office comes back and they're like, Tom, let me just get this straight. Did the real estate market just go up 35% in like 3.5 weeks? That's what happened here. But between December and mid-January, the real estate prices here went up like 35%. In under a month. And the Bank of Canada, later that month, the Bank of Canada did not raise rates. Tom, they didn't raise rates. That was documented.
Put my fingers on that keyboard and I can make it 100%. Yeah. I can make it 300%. Right?
Yeah.
And people who don't think that this is like, I don't know what to tell you, but it's just the sheer magnitude of them clacking on these keys as to how much it can or can't go. And it works in the opposite direction too. If you take the person off the keyboard and you let all this fixed income, because it's all fractional reserve promises, and as those promises blow up, this thing can unwind in the opposite direction down so fast, so insanely fast, because one person's promises is another person's asset, which turns into an impaired asset, which then cascades down. That's how fractional reserve banking works.
And if that was to happen, I think James Rickards wrote one of his books. He wrote about something he called Ice 9.
Yeah.
And he talked about like the whole financial market just absolutely freezing for 5 days or 10 days. And this is what I try to tell some of my friends. I'm like, hey, if the market was to come down, because there's a lot of real estate bears out here that are like, holy shit, everything's going to just go straight down. Equity markets, real estate markets, everything. I'm like, okay, let's play this out. So now all the Canadian banks are just going to fail. They're just going to let that happen. Or they freeze everything for your safety. They freeze everything for 5 days.
Yeah.
They sell people out to cash. They revalue what they have to sell out to cash. They revalue the dollar by printing a whole bunch of it to, give liquidity to who needs it. By the time you get whatever you want out of the financial system, your purchasing power might have been decreased by you might have a fifth of what you had a week earlier. Yep. And that's a real threat that I think you need to at least consider, or do not assign the probability of 0 to it.
Yes. That's the message that I have for somebody listening to this. Could that scenario play out? Of course. Could they just start leaning into this because it's an election year and they want the markets to rip going into the election? You bet. Do I know which one of those outcomes it's going to be? I have no clue. But I do know this. They're going to be clacking on the keys and they're going to be manipulating the markets, and it's going to be flowing into the hands of the people who hold a majority of the equity. The U.S. is going to get first bite at the apple, and then it's just going to trickle down throughout the rest of the world for everybody else that's trying to keep up with this debasement race that's taking place. None of it's fair. It's all manipulated and unfair. The only thing that I've found that's fair in the world is this Bitcoin protocol. That if you hold the private keys to that account, there ain't nobody that can debase you or take your freaking money. That's what I do know.
I want to jam in a couple more questions. Do you still have a few minutes?
Yeah.
Okay. Luke Roman talks about, maybe they just need to go 100% inflation for 3 years, kind of like, fix the problem. What do you think?
It doesn't fix the problem.
No, it doesn't. It doesn't. It makes maybe the numbers look better. It makes the numbers look better. It hasn't fixed the problem. Do you ever think we could see in the US 100% inflation for 3 years? Like, what's the probability of that to you? Is that something really that maybe could happen?
I think I would say this. I think anything's possible. I just don't know. I don't know if we could see those numbers or not.
It's big.
So much of it comes down to the people that are sitting in the room that are making these decisions and the knee-jerk reaction. I would say that to see something like that, you would need a COVID-like situation.
Yeah, okay, a crisis.
And an overreaction by the people clacking on the keys because when you're in that scenario, like, I don't know, Tom, how many trillions of units should we add? How much impairment is there? Well, I don't know. Nobody's even at work right now.
Yeah.
Right. So like they wanted to going back and reassessing the COVID situation. They didn't want to be shy on the amount of units that they added. And they overshot by quite a bit because we saw the inflation. I mean, like I said, the housing prices down here literally doubled in 4 years, right? So that's an overshoot. I don't think they wanted to do that, but they also didn't want people like starving and not having any money. So you're in this really weird situation where, but I think it's a scenario like that would have to produce some crazy.
Yeah, you're right. I agree, because that would give them the cover, because they could say then, oh my gosh, we didn't want to. Like we don't want any of this, but we had to. Like, look, it's for your safety, for your financial safety. I have a little bit of a strange question here for you. It's from a friend of mine. I promised I was going to ask him this question. He said, "Ask Preston the direction of the euro relative to the dollar." Do you have any comments on that?
I would just tell you it's sideways. It's perpetually sideways. And so within
a range, I guess.
Yeah. This is one of the things that masks all this so well. Okay, because if the U.S. comes out and let's say they debase the dollar by 10 or 20%, what you're really doing is you're now making the euro strong. And if you're over in Europe, now all of a sudden you don't have Americans buying your goods and services because they're too expensive. Okay. So now the top line revenue of all those businesses in Europe gets worse because you're not getting any type of foreign investment because the euro is too strong. Okay. So how does the ECB respond to this? Well, they've got to respond in kind by debasing the euro so that it makes it more competitive on the global stage. This is something people don't realize. Here in the United States, if you took all the companies collectively and you looked at the top line and where those buys are coming from, half of them come from international buys. Okay. So half of the revenue of these companies in the United States is coming from euros, is coming from yen, is coming from yuan, is coming from these other currencies. And if the dollar gets too strong, that revenue collapses quickly. And so then they have to debase the dollar relative to, it's this giant game of relativity between the dollar and all these other currencies that I just named. So if I'm looking at it on a long trend over the next 10 years, where do I think the euro versus the dollar is going to be? I think it's going to be exactly where it's at right now. It's going to be very similar. And this is what masks inflation, because a person would look at this and they're saying, well, the dollar's, relative to the euro, it's the same as where it was 10 years ago. Okay, now compare it to a bushel of whatever, or some type of real commodity that the cost to produce hasn't changed, which it has. It's become even more efficient, which makes it hard to even use that as a metric. This is why people like to use gold. But yeah, so when you're talking about fiat currencies, especially developed fiat currencies, they're pretty much going to stay within a certain range of each other. The one that I would say that's getting a little interesting is the yen. It's getting real interesting. We're seeing dollar to yen at levels that we haven't seen in decades. And so if I was going to argue with myself and trying to provide a counter argument, maybe the yen might be an area to watch that I don't know that they're going to be able to keep the peg like they've had it over the past couple decades. And a lot of this comes down to their fixed income market being the first one to break. So maybe that would be the canary in the coal mine for the opposite argument that the currencies are starting to be at odds with each other, at least large developed currencies.
I don't want to hog too much more of your time here, Preston.
Sorry to talk out of both sides of my mouth, but I think it's important for me to basically cover the spectrum of arguments there.
Agreed. Yeah, agreed. What are you doing with ego? We talked about it a little bit, but I first want to thank you with everything you've done with the podcast. I don't know how many times you've probably had the discussion, and maybe you're starting to think, holy shit, can I have this Bitcoin discussion for another little while? I'm here to say that you do such an incredible job. So many people I know listen to your podcast, credit your podcast for understanding things at a deeper level. So please know that although you've said things maybe 8 million times and you're getting tired of them, it's like us with real estate. I always joke that if somebody asks me on, how does a student rental lease work one more time, I'm just going to be like, I can't, so I don't know if you're at that stage. Luckily, Bitcoin's so interesting and there's layers to it. And now with your involvement with Ego Death, I just want to say that what you're doing with the podcast has absolutely been instrumental in my own understanding and many. So thank you for all the time that you're putting into that. But can you talk about like what's going on with egodeath? What are you doing with egodeath? Why are you participating with egodeath?
Yeah, a lot of it is I want to invest in where I think we desperately need infrastructure and growth, is this new world of finance, and Bitcoin kind of being at the heart of it. If you're not allocating capital into this to entrepreneurs that are just brilliant people that are building in this space, then who is? And so that's why I'm there. I know that's why the other general partners are also there, is for the mission first. Obviously, we think that in that particular niche, we can actually outperform Bitcoin, or we wouldn't be there because it's not value accretive to the limited partners. So we're there to help the limited partners make money. We're obviously wanting to make money in the space as well, but we're very passionate about what we think that this ushers in for humanity. We think that it brings in a fair unit of account, that it's not how close you sit to the money printer that assures your success. And I think there's been a whole lot of that over the last couple decades. So we're very excited about that. We've completed our first fund. The first fund that we did was focused on early stage mostly. The second fund that we're doing is much more focused towards Series A's. Still some early stage stuff. But the second fund is open, and we're still taking on capital. It's filling up pretty quick, but I appreciate the opportunity to talk about it, Tom. And we're very, very passionate about what we're doing over there. And
I think what you're doing allows, I know just with us, myself participating in it with my brother, for us, this is going to sound weird, but we feel like it's this way to contribute to the community.
Yeah.
So what you're doing, like we really value, just personally, I don't know, just gives you this a sense of purpose in a strange way, even though like we're way kind of in the back. So it really does. So thank you for everything that you guys are doing with egodeath. And then, you have a pinned post on Twitter. So I know you're on Nostr. We didn't even get a chance to talk about Nostr, but you're on Twitter at Preston Pysh. Your pinned tweet is something, if anyone's listening to this and wants to hear what Preston how Preston describes what's going on with the bond market, and how the foundation of the entire financial system is kind of changing a little bit. That pinned tweet is absolutely excellent. Thanks. It's at Preston Pysh on Twitter. Yeah, it's fantastic. The podcast, theinvestorspodcast.com. It's the Investors Podcast Network, but the URL is theinvestorspodcast.com. I'm sure everybody knows about it, but in case you don't, and you're living under a rock, there you go. You can find Preston there. Preston, anything else you want to share? I don't know, just anything top of mind about Bitcoin, equities, funds, the markets?
I'm excited about the future. We talked about earlier, like the prices of the homes going from, 8 years ago from 1,000 Bitcoin to 12 Bitcoin. Like there's a lot to be hopeful for when you start kind of understanding the deeper context of what's changing. I would tell people there's a wave to kind of catch and ride, especially long-term waves in finance. And if you can find it and deeply understand it so that you have conviction behind it, you have to do the intellectual work to get there, and question everything that I just said. This entire discussion, question it all. Just because it's worked out for me over the last couple of years does not mean that it's going to work moving forward. And people, the only way that you can find these waves to kind of latch onto and really benefit from is you have to do the intellectual work. My message is there's a lot to be hopeful for moving forward. It might look on the surface when you look around the world like things are getting worse, but I'm telling you, there are opportunities. It's like a yin yang, right? There's a seed of opportunity in everything that looks like maybe it's a setback. And I would just encourage the listener to find that seed of opportunity in what's happening in the world right now, because it's out there. And just really appreciate you opening up your audience to me to come in here and talk about it all, Tom.
Appreciate this, Preston. Thanks, man.
Yeah, thank you.